Welcome back, everybody, to episode 16 of Semiconductor Investing and More, the number one semiconductor podcast in the world, or so I like to say. Like always, I'm joined by two amazing co-hosts. First, let me introduce Nick. Good morning, Nick. How's it going?
Morning, Jose. Doing pretty well. How's it going over there?
Pretty good. Super excited. We have a great lineup. Obviously, we're going to talk about one of my favorite semiconductor companies. They just reported earnings. But before we get to there, I want to introduce our second co-host, Billy. Good morning, Billy. How's it going?
Going great. How's it going with you, Jose? I got my cup of coffee here. I see Nick has some brandy or something. I don't know what that was. We were just it was Coca-Cola, right?
I have my water.
But no, real excited. We got a lot of big, heavy hitter stocks to talk about today, so I'm pretty excited.
Yeah, so for the viewers, like always, this is going to be a 6-topic episode. The first topic we're going to take a closer look at is Intel, its recent dividend cut. Then we're going to jump with Applied Materials. We're going to then follow through with the new Germany fabrication plant that Nick might explain a little bit more. We're going to take a closer look at the server memory side, Broadcom and VmWare updates, and end the episode with Nvidia updates. So let's get started. All right, guys. So for topic number one, we're going to start off with Intel. And this is recent news that Intel is cutting dividends. I want to say I'm kind of shocked by how many people seemed shocked on Twitter that this was going to happen. I think that was the biggest shock factor for me. But if we take a closer look at the news, Intel drops their dividend from 36.5 cents to 12.5 cents, a 65% reduction. And I kind of talked to Nick, I believe, yesterday before Nvidia earnings. We did a live stream, and he gave me this point where right now, trailing 12 months dividend payout has been roughly $6 billion. With the new cut, new dividend will still be a $2 billion annual cost. And one question I'm going to have for you guys later is, why do you think we're still holding, Intel still wants to hold at least $2 billion in annual cost here in the dividend side? To me, outside of people being shocked, the second biggest shock factor for me was that this did not go to zero. If we take a closer look at the chart I have here, I have a few things there. First, on purple, we can see, like I mentioned, about $6 billion in trailing 12 months of total dividend pay. Then I do have in yellow or orange, I'm pretty sure, free cash flow in trailing 12 months. Unfortunately for Intel is about $9.6 billion. Obviously, free cash flow doesn't include dividends, but I just wanted to showcase how this company is burning a nice amount of money. I also wanted to take a closer look at the quarterly for it. Free cash flow in the most recent quarter was positive $2 billion. But we can see in the past 2 quarters for Intel, free cash flow quarterly has been on roughly negative $7 billion. So definitely a huge hit there. So they do mention that the reason for these cuts are for cost-saving plans. And this is not the first thing they're doing. They have also done reduction of workforce, unfortunately. They have exit of 7 non-core businesses since 2021. I do believe when we looked at Intel's earnings, Nick kind of mentioned how they were living, I believe, the networking side a little bit more. They were kind of exiting that core business. And unfortunately, there are reports of pay reduction plus other benefits like bonuses and 401k reductions. Intel believes that, hey, this year in 2023, they are delivering about a $3 billion in cost savings, and they are on path for roughly $8 to $10 billion in annualized savings by the end of 2025. So before I take a closer look at the next slide, where I kind of explain a few reasons for maybe this cut, what is Intel really spending money on, I want to hear from you guys. What are your thoughts from this Intel cut? I know Nick probably has a lot to say, so instead I'll pass it over to Billy first. I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
Yeah, not much to say. They cut the dividend by 2/3. It was. I mean, I've been counting down the days for this to happen. I think since like last summer. I just didn't see any way. I mean, they've been. If anything, I'm surprised they haven't done it earlier. Again, they embarked. The big picture is they embarked on this massive spending plan to catch up to TSMC and to build out their own third-party foundry and invest in their own chips. And they're doing that when their core source of cash flow, which is the PC business, went into its worst downturn since the 90s. So that's unfortunate timing for CEO Pat Gelsinger. That's why you see them doing things like selling part of Mobileye, partnering with Brookfield to get third-party financing for the new fabs. It seems like they did just about everything under the sun before deciding to cut the dividend. And I think the reason they didn't cut the entire thing was that I guess they wanted to maybe signal to investors that they're going to be still generating cash flow maybe next year. Maybe they want to give themselves like a little extra like emergency cash in case things get worse. Maybe we can go back to that 2 billion if we really need to cut it to zero.
Mm-hmm.
So not great at the moment for Intel in general.
Yeah, that's definitely a great point there, Billy. How in theory this company can later on, hey, if we need that extra 2 billion, we can go and kind of just get it from here. Nick, any thoughts here? I think you might have a few.
I'll abstain till the end. How about that? That way I can rant all in one go.
Are you?
All right, Billy. So let me continue to the next slide. It's just a few reasons for the cut. I mean, Billy did mention, right, that this company is going through this massive expansion in the manufacturing side. And luckily for Intel, it is coming at a time where we are seeing a lot of subsidies globally, right? The CHIPS Act here in the United States. I'm pretty sure we're seeing one in Europe. I forget the Europe CHIPS Act as well. So Intel has been expanding or has plans to expand into numerous markets. But unfortunately, I believe that this comes at a more expensive cost than they initially thought. For example, there was a recent article that came out of about a week ago that reported that Intel was asking for more money in Germany than they initially asked for during the subsidies. I believe they had about 6.8 billion at first. Now they're asking close to 10 billion euros, so about a 3.2 billion euro increase. So it seems like things are getting more expensive. Maybe the subsidies aren't enough to cover what they need, so Intel needs to find that money elsewhere. Outside of that, just like Billy mentioned, right, it is at one of the worst time in the computer for the consumer side. We can see Q1 outlook for this company is expected to be roughly down 40% year over year on revenue for this upcoming quarter. And then again, this is a company that at the same time of doing that huge manufacturing investment is doing enough to they want to do 5 nodes in 4 years. They want to release they expect to release 2 consumer CPUs in the next 2 years, one in the second half of 2023 and one in 2024. They have three data center or server CPUs scheduled for the next 2 years. Emerald Rapids in the second half of 2023, Granite and Sierra in 2024. So and not only that, they're also focusing on the accelerating group, which is the graphics card market, which they're trying to enter more into the space. Rightfully so. We're going to see why NVIDIA is dominating this space in a bit. But Intel is trying to do so much at once, and it definitely needs that money right now. This is all I have for Intel. I am going to pass it to Nick. Because, Nick, I think you even mentioned something in the live stream yesterday that I really enjoyed, that you mentioned with this extra $2 billion that Intel didn't cut, they could have used that money for X amount of machines. Can you explain that a little bit more, Nick?
Yeah, I was being tongue in cheek, I guess, when I tweeted it yesterday that the $2 billion in dividend that they're going to continue paying to primarily institutional shareholders. I'll get to that in a second. The issue I have with that stupidity. But $2 billion a year in dividend payments will pay for about 8 ASML extreme ultraviolet lithography machines every single year. Intel has been hanging its hat on now ever since Pat Gelsinger came in on this third-party fab service, Intel Foundry Services, that they want to open up their manufacturing to other to other chip companies and manufacture for them. They're going to need these EUV machines to do it from ASML, and they are not cheap. So, I mean, I'm with Billy. Like, the only thing that's shocking about the dividend cut is that they didn't do it sooner. You need the money. It's expensive. And then, Intel goes, hat in hand to Germany and to the US asking for subsidies to build these fabs. Like, stop paying institutional investors. Institutional investors do not turn a business around. And like you said, Jose, one of the first things they cut was their talent, their people. People turn businesses around, not institutional investors. Stop paying institutional investors a stupid dividend. What is it going to be, 2% a year now? There are hundreds of stocks that'll give you a 2% dividend yield. Intel doesn't need to be one of them. Pay your people, pay your talent to turn the business around, get things moving the right direction. I'm starting to get irritated with Intel. 2 years ago now, I was asked my opinion on Pat Gelsinger coming in as CEO, and I said, you know what, maybe it'll be great, but I'm going to wait and see. I want to see what he does. He was brought in to make tough decisions, and 2 years later down the road now, I have not seen any difficult decisions made. I have not seen any big transformational decisions made to really aggressively get Intel back on track. And one of the things that they have said that they've done recently is help get the U.S. CHIPS Act passed with all the lobbying. But I would argue that's a result of the pandemic. The U.S. was going to pass the CHIPS Act anyways because of the chip shortage and the supply chain issues. That was a done deal. Maybe Intel kind of helped push it along a little bit, but that's also going to help all of Intel's competitors as well. This dividend thing is total, utter nonsense. Get rid of it. Save the money, pay your people, fix the business. End of rant. Sorry, guys.
Thank you for that, Nick. And I definitely want to hear from the viewers right now. How are you guys, if you are an Intel investor, how are you feeling about this dividend cut? Are you upset that it's not even further? Like you mentioned, right? Nick mentioned, and like we said earlier, talent was one of the first things to cut off. And if you're trying to become the best chip designer, if you're trying to become the top manufacturing, what do you need? You need talent to stay with you. And not only that, I mean, just seeing the loss of talent is going to break down morale within the company. And that alone kind of can also change the whole setting of what can happen in the future. So thank you for that, Nick. Billy, any final thoughts here before we take a closer look at the next topic?
No, it's pretty much a disaster for Intel. I mean, Pat Gelsinger has dealt a pretty terrible hand, so I have a little bit more sympathy for what he's doing. I'm not sure he has any good options. We can question whether he's making the right decisions, but there are no really great options with your core business in a 30 to 40 to 50% downturn or whatever the PC unit shipments are. And you're behind in process technology, which happened before he got there. So, yeah, I mean, I'm rooting for him. Intel is a great American manufacturing company, but I advise people to go to the sidelines and observe this. It's gonna be a while before you know if this is working out or not.
Definitely. Thank you for that, Billy. So I think that brings us to the end of topic number 1. Next, we're going to take a closer look at topic number 2, and this is going to be Applied Materials. The company recently reported earnings, and Billy's going to explain to us a little bit of how this company did. So passing it your way, Billy.
Okay, Applied Materials. If I had to pick just one stock in the semiconductor world to own, it might be Applied Materials. It's got the broadest portfolio of semiconductor equipment. As we can see, capital intensity is going up. So it's quite diversified. It trades, I think, at a low to mid-teens valuation. So you're getting some good value there. And it's very capital light. They generate lots and lots of cash. It's just really good all around, and you can see the benefits of that diversification of its exposure in the recent earnings report that came out last week. So Applied, its revenue came in up 7%, beat expectations. Adjusted EPS came in $2.03, up 7%, also beating expectations. Again, kind of impressive given the big downturn in a lot of the end markets. But remember, these guys had a tremendous backlog last year. They were supply constrained, so they are getting the benefit from some of that. However, their forward guidance was still pretty good. It was much better than Lam Research, which is more exposed to memory. And they guided for $6.4 billion, but it's a pretty big range, plus or minus 400. I'm guessing they're going to come in above the midpoint. Also, there's a $250 million headwind. So the guidance would have been $250 million more. So about even from this quarter, had it not been for one of their suppliers, MKS Instruments, had a ransomware attack, which limited shipments of, I think MKS provides gases or some sort of chemicals to Applied Materials for their machines. So that was actually holding back sales in the current quarter. But management says they're probably going to recover that in the following quarter, if not sometime this fiscal year. So not too much to worry about right there. Amazingly, the company grew its backlog last quarter for the 9th consecutive quarter. However, it does expect eventually that it to work down the backlog as we go through the year and should normalize over the next 4 quarters. So it's like, how are these guys still growing their backlog when the PC market is down? All the memory players are cutting back like 50% on their capital spending. Leading edge isn't so great either. The reason is these guys actually have, again, it's their balance. We've talked about the strength of automotive and industrial and power chips, analog chips, Internet of Things chips. And those, we talked about Texas Instruments' massive build out of their new fabs, and sales of that segment are booming. They expect that to be up this year. As you can see, Applied is exposed, now it's 77% foundry and logic customers, up from 60% last year this time. And memory machines are only 23% of their sales last quarter. And that dispersion could even get wider. Management said on the call about half their foundry sales are to something called ICAPS, which I think stands for Internet of Things, communications chips. I forget what the A is. Analog maybe, and power chips and sensors. That's it. So this is all the Texas Instruments stuff. We'll see it's Infineon, it's Microchip. Those sales are still going strong. In fact, they expect ion implant machines, which infuse wafers with certain properties that go into a lot of power semiconductors. They expect those machines to double this year, which is a good part of their ICAPS division. So that is what's really sustaining them here and should enable them to post some not great, but decent numbers this year, even in a down market. Importantly, their services division, which is about 60% recurring revenue, 60% replacement parts, they still expect that to grow in fiscal 2023. It was down quarter over quarter, but I think a lot of that is the China regulations kicking in from last summer. Basically, the U.S. banned the most advanced equipment to China's leading edge and memory companies. So that's affecting them in the near term, but they still expect that to grow this year, which is pretty impressive. That's less volatile. It's about low 20% of their sales. And then looks like this part got cut off in the slide, but they're actually these guys don't have the capital intensity of like an Intel or a TSM. So they have cash to invest through their cycle, repurchase stock, and pay dividends, which is why I like it. They're investing in a new R&D innovation center this year, which will bump up capital spending a little bit, but they said it should speed up their innovation and time to market. And another thing, a final thing, is that these guys really impressed me. The ICAPS strength is not an accident. Like, they saw this coming 3 or 4 years ago. They developed an internal division for ICAPS and have brought a lot of new machines on that front over the years. So when these guys have such broad exposure, they're able to sort of see around corners and what's coming in terms of the innovations that their customers need. So I found this report really impressive. They also mentioned there's a trend on the leading edge, which is weak this year. Samsung is doing this thing where they're going to a new type of transistor from FinFETs to something called gate-all-around. And Applied Materials said on the call that they're very well positioned in gate-all-around transistor technology, which will be the new trend going forward. They said they're going to pick up about 5 points of market share when the transition from FinFET to gate-all-around. So that should benefit, not this year maybe, but maybe the following year. So I really like this report. They generated a fair amount of cash, didn't buy back as much stock in this quarter, which was something to keep an eye on, but they had bought back a ton of stock earlier in 2022. I don't know. I think it's, for long-term shareholders, I think it's, even though it's had a big rally off its lows, I think it still looks good here. Anyway, I've been a shareholder for a while. I really like it. I'll turn it over to you guys.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. Thank you for that, Billy. I mean, it is, to me, it was surprising how their revenue was still up 7%, even though their memory market took a huge hit. Right? It seems to be down. I do have a question. Maybe either you or Billy, maybe you, Billy, or Nick can answer. One thing that has me worried about, I don't believe I own any equipment company, but one worry that I do have is that, hey, right now we are seeing this huge growth in the manufacturing side, right? So a lot of these companies are going to see a nice amount of backlogs or a nice amount of orders for the next few years. At what point, when that changes, does the thesis for companies like this change? So it's like, sometimes I'm worried. This is where I'm worried. I'm worried if I buy a equipment company, I'm not going to be able to time perfectly when to come out when we start to maybe see that decline in manufacturing. I think both you, Billy, and Nick, own equipment companies. How do you guys see that, or how do you guys think about that when having a company like AMAT? I mean, obviously, we're seeing strong growth all around right now. They're not only in the foundry business, the memory market, and they're also really good in that ICAPS, which is that trailing edge. So there's definitely a lot of growth opportunities, and I see that. But I have that fear of me not being able to determine when to get out or maybe to stop looking at such a thing.
Yeah, I've owned this one. Actually, it's the oldest chip fab equipment stock in my portfolio. I like it more than ASML for a lot of ways. Billy mentioned it has the broadest portfolio of all the chip fab equipment companies, and that's very powerful because they're able to pivot and focus their allocation of capital on whatever segment of the chip industry happens to be growing, which is really powerful. So like, even ASML is going to be much more cyclical, I think, over time, because they only do lithography. Interestingly enough, Applied Materials actually supplies key equipment that is needed to run an ASML machine. Without the reticle components that Applied Materials makes, you can't really use an ASML machine. So Applied Materials hits on lithography. It hits on that lagging node, ICAPS, the memory market. Because of that, it is an incredibly powerful business. Jose, I kind of get how you feel on that. It's kind of the problem I had with the chip fab equipment companies too, but it's why I started with Applied Materials. I think I've had it for almost 4 years now in my portfolio, and I just add to it whenever there's a dip, because I think it's broad based. I think it's going to be actually less cyclical than average, and it's a very shareholder friendly company. The cash return that they're able to dole out is awesome. It's just a great business, all around business.
Yeah, and I just say, like, if you're investing in any chip stock, there's there's going to be cyclicality to it, right? So even if you're in a stock like Nvidia, what did Nvidia's sales do the last couple quarters? They went down. Even Nvidia is cyclical, but it has secular growth, and we're seeing a big build out in manufacturing right now, but that's going to last a few years. And as long as the amount of chip units continue to grow, they're going to need equipment. If the semiconductor industry does grow from 600 billion to $1 trillion by 2030, there's still going to be investment. Every time you move to a new advanced node, you also need more equipment, even if the units don't go up. So, and then another thing I like about the equipment companies is that they have this services element, which is like 20-25% of their sales, which is not totally recurring, but a lot of it is recurring, and a lot of it's tied to the installed base. So you have this segment, which is kind of less cyclical, and gives a little bit of stability. But you're right. I mean, it is cyclical. Some of these down cycles can be pretty violent. And the other reason I like Applied is that it's not that expensive of a stock. It's, I don't know, 13, 14 times earnings right now. And if earnings aren't going to go down that much, it's going to be pretty cheap if the industry begins growing again in either 2024 or 2025. So it's a good one to at least monitor, if not have in your portfolio, because they have a lot of insight into what's going on in the market.
Yeah. Thank you for that, Billy. And I think I feel like my issue is with I need to understand this market a little bit more, where I understand in the advanced companies that I follow that it is cyclical, but I feel like I can understand where that cycle is. I feel maybe my problem here is where in the equipment side, I'm still not too familiar with how the cycle tends to do. So maybe I just need to understand a little bit more of where it's at the moment. So thank you for that, Billy. Thank you for that, Nick.
We're all trying to figure that out. Even long time observers of the industry. Yeah.
So I think that's it for topic number 2, and I think we can move on to
so we're going to talk about a company called Infineon. Interesting thing. So Infineon is a customer of Applied Materials, which we were just talking about here. Just a thing on the cycle. It's interesting to me. We talk about these cycles. This current down cycle for Applied Materials is actually not a down cycle at all. It's more of just a flat line before it continues to grow again. And one of the reasons for that is what we're going to talk about right now, Infineon. So last week, Infineon is actually Germany's largest IDM, integrated device manufacturer. So Infineon is one of those companies, kind of like a Texas Instruments, where they both design and manufacture chips. So much like here in the US, there's the US CHIPS Act. Europe is working on the European CHIPS Act. So this new Infineon fab that they're going to build in Germany is in conjunction with that European CHIPS Act. So they're going to break ground on a new 5 billion euro fab later this year in Dresden, Germany, which makes a lot of sense because Germany is an absolute powerhouse of a manufacturer, especially for the automotive industry. So much stuff, so many parts for the auto industry get manufactured there. Of course, 2 of the world's largest auto manufacturers are there. So this new fab is going to be in support of that specifically. So I've got the press release up here and I've got it kind of color coded in green there. Some of the uses for these chips that are going to be made at this facility: renewable energy, data centers, electromobility, basically electric vehicles. So a lot of energy efficient stuff. And then in the blue here, we've highlighted on episodes past, Europe currently is just a single digit percentage of global chip manufacturing. The reason they want this European Chips Act in place is they would actually like to be 20% of global chip manufacturing by 2030. That's going to be an incredibly tall order. But this is one way they can do it, is if they help companies like Infineon ramp up production. So construction is set to begin in 2023. Manufacturing will begin in 2026, the autumn of 2026. And so dropping down to this next slide, this is an old slide now over the last couple of weeks that I think I've shared every single time we've done an episode, so I hope no one's sick of it. But the global spending on wafer fab equipment, of course, the dip from all-time highs in 2022, expected in 2023. But the preliminary estimate is this thing rockets back up to close to or above all-time highs starting in 2024. So like we were just talking about with Applied Materials, that's why these fab equipment companies are in such a powerful position. All of these companies are breaking ground on new fabs in the US, in Europe. There's new ones breaking ground in Taiwan and Japan, in Southeast Asia. It's like an arms race. It's a modern arms race. And companies like Applied Materials sit at this choke point within the industry where I believe they are going to eat the lion's share of profit as these fabs are built. All of these companies, no matter who it is and what kind of chip they want to manufacture, have to go to Applied Materials, specifically Applied Materials, because they offer so much in the way of equipment. So I think this Infineon deal is interesting. One of the reasons I think it explains why Applied Materials is able to kind of, during this down cycle, just flatline, keep their revenue going, at least flat year over year, if not up by a low single digit rate. And I think, I'm not an Infineon shareholder. I have zero plans to be, but I share this because basically a lot of new equipment is going to be flooding into this new factory in Dresden, Germany. So thoughts here from you guys. Favorite chip fab equipment stocks? Billy, I know you own quite a few of them. Jose, have I lured you off of the sidelines here? You going to make a buy in the chip fab equipment space?
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. Here we can see construction is set to begin in 2023, with beginning of manufacturing activities planned for fall of 2026. And that beginning of manufacturing, I'm pretty sure, is probably going to be less than 50% of the production line, if that. So it just continues to show that, hey, while we are seeing these huge investments in manufacturing, it's going to take a long, long time before we start to see the actual results, right? And if I do think recently, Nick, I've been even though I haven't purchased any, I think I'm leaning more into the equipment side than the manufacturing side at the moment. And I don't know if it's because I'm just hanging out with Billy too much. So those are my thoughts. I'll pass it to Billy. Maybe he has something else to share.
I want to get you in trouble, Jose. A bad influence. Yeah, it just goes to show the strength and the growth prospects of that ICAPS, what Applied Materials calls ICAPS. Internet of Things, sensors, power, analog for automotive and industrial IoT. There's a big emphasis on manufacturing. Germany's actually, obviously known for its auto industry, as is Japan. as is America. And there was a shortage of those types of chips last year. And it looks like all these governments are going to make sure that never happens again because they're giving away all this money to build local chip supply. So it's going to be good for the Applied Materials ICAP segment. Again, there's some other niche equipment companies I actually don't own that are purely exposed to that stuff, like Air Test and Excelis, which is the other ion implantation company that we're not talking about. But it just looks like there's a good amount of runway for this investment. When you look at Infineon compared with Texas Instruments, there's just a lot of money going to that, which is remarkable, even as PCs and smartphones are in just about the worst downturn in recent memory. So it's kind of crazy times. It's a very bifurcated market this year. But if you're diversified like Applied Materials, it just looks like you're flat. But there's a lot going on underneath the surface. So, this is another bit of evidence that trailing edge is the place to be in the next year or two.
Billy, server to overtake smartphone in the DRAM. Sounds pretty interesting here, so I'll pass it your way.
Yeah, just a quick one here. Because I'm a masochist, I'm invested in the memory market, which is the most cyclical of this cyclical industry.
Misery loves company. Me too, Billy.
Memory is sort of like the commodity or oil of this industry. So huge swings in price per bit. It's totally boom bust. But what is interesting about this is that memory has been dominated since the iPhone revolution by mobile phones, which was almost half. A few years ago, as recently as a few years ago, was over 40% of all memory DRAM bits sold. So for those who don't know, there's DRAM, which is dynamic memory, which is how your device accesses bits when it's turned on. And then there's NAND flash storage, which is what stores data when stuff is turned off. So all the major memory players, Micron, SK Hynix, and Samsung do all three. And then there's a couple other NAND players. But part of the reason I'm in Micron was that I thought it was going to become a little less volatile over time. That looked like that was wrong this year. Memory market's terrible. But part of the reason I thought this was that cloud servers and the build out of AI is going to make servers a higher portion of the overall memory mix. And auto is also growing, but auto is at a really, really low base. It's like 5% or something of the memory market, but that's growing fast. So the chart on the right, as you can see, this year is the year that server memory is going to overtake mobile memory in total bits produced. So this is because all the stuff we've been talking about, artificial intelligence, big data processing, the build out of cloud. Meanwhile, mobile phones kind of slowed their pace of increases. So memory content per phone for 5G phones is going up. But last year, when there was all these headwinds, the content growth is still growing, but it's slowed down. So I think content per average smartphone only grew like 3.9% last year. That's supposed to accelerate a little bit to 6.7% content per box on average this year, but it's still going to be like below the 10% that some had like forecast. Meanwhile, I think content per server is going to grow at 12.1% thanks to artificial intelligence, high performance computing. Moreover, this article from TrendForce, which is a pretty decent source for memory news, noted that in servers, there's some price elasticity to memory, which is that as memory prices fall, and memory prices do fall over time. This is because memory producers go to the next node, they crank out smaller memory bits on the same wafer, so you get lower cost per bit, so you're able to sell it for less. This is why the cost of memory has plummeted over the last 10, 20, 30 years. But as prices fall, the end device makers start to use more of it in their devices. So because DRAM is down, I don't know, some DRAM prices are down like 50% or something from last year, something crazy like that. So you're starting to see server manufacturers use a lot more bits. They're packing more bits into each server, basically to give them more horsepower. Now, obviously, when you have a bust like this, that can lead to a boom. Why is that? Because all of these servers now have all this memory in their latest models. Because of the downturn in memory, all these memory producers are pulling back on production. Then you're going to get more demand later on, and supply will be down this year. So that could fuel another upturn. So that's why I'm cautiously optimistic, even though I think the current quarter and the next quarter are going to be absolutely terrible. And it's also why stock like Micron is sort of stabilized in this area instead of continuing to fall, because memory investors know this. And then also one last note, same thing also goes for NAND. At the bottom of this article, they mentioned NAND content. NAND content per box is going to go up 20% for smartphones and servers this year. NAND is actually an even worse business than DRAM because there's more players and the price wars are absolutely horrendous. However, as you can see, there's going to just pack a lot more storage into each server. Might there eventually be an upturn in the NAND business? These guys think that enterprise servers will surpass mobile NAND by 2025. So I just thought it was interesting to note that sort of the end market mix for memory, which is like a proxy for the semiconductor industry in general, it's skewing more and more towards servers and away from the total dominance of the smartphone. So just interesting to mention here. And I'll turn it back to you guys.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. Thank you for that, Billy. Nick, any thoughts here?
Yeah, I'm glad you brought this topic up, Billy, because I was asked to appear on another investing podcast, and in doing prep for it this week, I was presented with this data point that predicted that smartphones will still be the largest end market for chips overall by 2030.
Yeah.
And I had to think about that, and I thought, I don't think so. Based on my research and what I'm saying, I think it's going to be servers and data centers. Now, what you just presented is only memory chips, Billy, and logic obviously is a much more, it's less commoditized and therefore a much more expensive type of chip. But I think it still is going to kind of follow a general trend that direction, where I think servers and data centers will far outstrip smartphones by 2030. And I think the memory chip market is going to kind of lead the way in that department. What do you guys think?
Memory's got broad exposure to the whole industry, but then like the actual dollars, you know, like if a Qualcomm chip is more expensive than a data center processor, that will actually get more dollars. So it's hard to know where the actual majority of dollars will go, because logic chips are all priced at different points. Although, you know, as we'll talk with, NVIDIA's newest chips are going to be very expensive. So if those are packed into data centers, I can't imagine. I tend to agree with you. I think the data center and servers are still going to be the largest by 2030. I just don't see. It's like, how much more powerful can your smartphone get?
Right.
Once everybody has 5G phones, which will probably happen in the next couple of years, it's like, where's the growth going to come from?
6G.
6G. Meanwhile, I think the computing needs of AI and high performance computing are only going to continue to keep going up and up and up. So I agree with you. I'm not sure about that prediction.
Yeah, the only thing is, you know how the phones became kind of a computer? If eventually the phones become kind of a data center in their own way. So,
Ooh.
boom. I can't see a future like that, but who knows? Maybe it could happen. Um, but I mean, this was a pretty awesome topic, Billy. I was surprised of how heavy the memory market still was, because I did believe that, hey, maybe at least some strength from the server would help it, and maybe it did. Even though it still looks bad, it probably would have been a lot worse without without the server side. But I remember, I think we've talked about it a few times. Micron had their Investors Day presentation where they showed how, yes, right now mobile is dominant, but in the next few years, they definitely see some of these other markets being a little bit bigger of a driving force. So maybe that thought process is right. Maybe we were just a little bit too early for it. Maybe in the next cycle we might see things a different play out a different way.
Yeah, you're right. And even though servers are on the rise, I mean, smartphones are still, I mean, that's still a huge percentage of the memory market. And PCs are also not on this, but they're still probably like 20%.
Mm-hmm.
So that's another big chunk. So if you still have mobile and PCs, which are in like a terrible downturn, that's still a majority of the market that's in a terrible downturn. And even if data center is growing, but it's slowing down, when you get the crash in the other segments, it's still a down market. But this is more about the long-term trend over the next couple of years. I think you're just going to see more and more of the rise of servers.
All right. Thank you for that, Billy. And I think we can move on to topic number 5. Here for topic number 5, we're going to take a closer look at Broadcom and their acquisition of VmWare. There might be some updates that Nick wants to share with us. So, Nick, I'll pass it your way.
Yeah, speaking of the server market, Broadcom, obviously a big supplier to servers and data centers. Of course, the big, maybe I shouldn't say big. This is a huge acquisition that's pending. Broadcom, at the time that they announced the acquisition in May of 2022, it was valued at $61 billion. It's a roughly half stock, half cash purchase. So it's going to fluctuate. The actual value will fluctuate based on Broadcom's stock price. But I feel like this does not get talked about hardly at all. So let's talk about it, because it's kind of a big deal. So, of course, anything that's this massive is going to draw tons of regulatory scrutiny. This is an absolute heyday if you're an antitrust or competition regulator. And so that's essentially what's happening. I think Broadcom expected this deal originally would close like the first half of 2023, but they had a filing last week that pushed it back another 90 days, another 3 months. And the reason is regulators in the UK just started taking a look at this deal. The EU, Jose, I think it was maybe late January or early this month on a different episode, we talked about how the EU was going to begin a very long, extensive review that's not going to be finished until June 9th. So this deal, all of a sudden, probably we're looking at late fiscal year 2023. And that's fiscal year 2023 for Broadcom, which is October 2023. So this deal is getting pushed back. I think maybe I have a couple other comments here. I really hope it goes through, and not just because I own Broadcom stock. I think from like a immediate term shareholder value standpoint, I kind of hope it doesn't go through, because it's very expensive. Broadcom's going to have to take on a lot of debt to make this acquisition. But I think there's some good long-term reasons. From a marketplace standpoint, I think we should all hope the deal goes through. But at any rate, I do have some questions for you guys. We talked about this when Nvidia tried to buy ARM a couple of years ago, and I think I asked you exactly the same question, Jose and Billy. Will regulators sign off on Broadcom acquiring VMware? What do you think? What are the odds?
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
I have no idea. I would say I don't know why they would stop it. On the other hand, regulators are sort of, how shall we say, they're sort of on it seems like they're on a mission these days to try to stop big deals. I don't see why this chip company purchasing a giant software company is going to hurt competition in the software industry. I just don't really understand why. Maybe there's some conditions they can satisfy for regulators as part of the deal. I just don't know why they would stop it. But I don't know. There's every data point, every news item around deals always talks about how they're on the brink of breaking down, and then sometimes they go through. Yeah, I don't know. I kind of hope I own some Broadcom too. I kind of hope this deal goes through, and then part of me also hopes it kind of doesn't go through. I'm not quite sure about VMware's. The cloud giants are kind of coming for the private cloud, hybrid cloud market. They're all selling their own solutions like that let people build their own data centers with like their cloud templates. And I'm kind of wondering about VMware's competitive position if you got all the cloud giants coming to try to wiggle their way into the hybrid cloud market. But that's a whole other discussion. But it's just another, massive, it's like the bigger the deal, the more scrutiny it's going to get. And this is a massive deal. It's $61 billion.
Yeah.
I mean, that's almost as big as the Activision Blizzard deal. So I don't know. We'll have to see. Broadcom's not a big position for me, but I do own some of it. And yeah, I trust that Hock Tan knows what he's doing. It's going to be interesting. I don't know. There's no other chip company that has this much software, right? It's like Broadcom started buying software companies a little while ago. It's like a quarter of their sales now. There's no other company that's like half chips, half software. It would be a really unique. If this deal went through, Broadcom would be like a really unique asset in the industry. I'm just not sure if VMware is worth that much, but that could just be me not knowing what I'm talking about. I'm not a total expert in hybrid cloud and the moats there. I just feel like if you get the big cloud giants coming after the private cloud market that they're all trying to do, it's pretty tough competition. So, of course, Broadcom could also bring that up to regulators and be like, hey, we've got plenty of competition. Don't worry about it. I think they'll do fine if it goes through. I'm just not sure it's going to be like a total home run, but more like a stabilizer through the chip cycles. But I don't know. What do you think?
First, I just want to say I agree with Billy. If this goes through, that kind of mixture of this would be a very, very unique company of very chip-based and software-based. And I really would like to see that, right? When I think of chip and software company, the only one that I can really think of right now at the top of my mind is obviously Nvidia, but it's nowhere near that space. I think we looked at yesterday, Nick, that $100 million in revenue comes from the software side, a few hundred million. So it's nowhere near where this would go. Where it comes to comparing this to Nvidia and ARM, I saw the reason why regulators would want to stop that, right? There was definitely that kind of neutrality that ARM had and was kind of keeping in there. So I understand where regulators had some stepping stone to stand on. In this one, I think the only stepping stone that I see is that the size of this deal. right? I think regulators right now are just, hey, something this big is something we have to keep an eye on because we just have to do it. But I believe if they kind of continue or making it seem like this is more against the big tech like Amazon, like making this deal seem like, hey, it's gonna be for, like they mentioned, for customers to be able to control their own destiny. And if they continue with that agenda, if I may say, I think the chances of it going through are bigger. But just like Billy, even though that mixture of two seems very interesting, I don't know if 61 billion is what's worth to pay for that interesting company, right? So it's definitely, I see the growth opportunity, but I can definitely see why certain investors might be a little bit worried about it. I do want to hear your thoughts, Nick, on what Billy mentioned, right? What do you think as a shareholder of this deal?
Yeah, so that's exactly my concern. I'm not sure VMware specifically is worth that hefty of a price tag. However, Hock Tan is very well respected. I think he's Malaysia's wealthiest person, like by a long shot. I think he knows what he's doing. He's been at this for a long time. He is a master at merger and acquisition, and he has surprised me every single time over the last decade. His ability to squeeze tons of profit, like ridiculously high profit margins out of acquisitions, especially on the software side. So I don't know. As a shareholder, it makes me nervous. But on the other hand, though, this is why I think regulators really need to let it go through. We've been talking now for months about big tech starting to encroach on the semiconductor space by designing their own chips. Broadcom, interestingly, I think is the company that is leading the charge from the opposite direction, not Nvidia. I think Nvidia is kind of taking some cues from Broadcom in this department and saying, hey, you guys like chips? Hey, big tech, you like chips? We like software, and we can do software too. And I think Hock Tan makes a really brilliant case for letting VMware be acquired. Basically, hey, we're going to present new competition to Amazon AWS, Microsoft Azure, and Google Cloud. And if there's one thing regulators have absolutely hated the last few years, it's big tech and the lack of competition against big tech. Broadcom is basically, Hock Tan is saying, hey, you want competition for big tech. We are now competition for big tech. Let us make this acquisition. And we're going to allow companies, like Hock Tan said in a recent presentation, we're going to let companies control their own destiny when they start building cloud and hybrid cloud and private cloud infrastructure and applications. So I think this deal should go through, and I really hope it does, even if I think in the short term it could cause some, maybe not so pleasant outcomes for shareholders. I think the long-term reason is very sound.
All right, guys, listeners, thank you for staying tuned. We're going to take a closer look at topic number 6. I feel like this episode I learned so much, and this is why I enjoy having Nick and Billy here to continue to learn about the semiconductor market. So next, for topic number 6, we're going to take a closer look at Nvidia. Q4 earnings, company just reported yesterday. And I just want to share some insights of what I'm looking at in the earnings, and obviously get some thoughts from Nick and Billy. So the first slide here I'm going to take a closer look at is taking a look at their revenue. So if we take a look at their revenue trend, data center is down quarter over quarter, $3.6 billion versus Q3 of $3.8 billion. They do mention one of the biggest factors here is China is still kind of seeing a slowdown in this space, and that's what's really dragging the growth here. Another thing, though, that I was thinking of here in the data center market, we are seeing this huge acceleration in AI, generative AI, and that could definitely push growth into this market. But I do feel that maybe investors should at least kind of keep in mind that Q1 of fiscal year of 2023, since then, it has pretty much flatlined revenue for the past 4 quarters. So maybe from here on out, expect maybe not the biggest grower on a year-over-year basis for this industry, something to keep in mind now until maybe China does come back and until we do see the true effects of that generative AI. So I do believe, at least for now, maybe the data center year-over-year growth might be a bullish story for the long term of things, but in the short term, it might have to put a pause on it. I do believe one of the biggest things here was the gaming was up 16% year over year. This was the biggest drag force for Nvidia in a while due to over inventory correction. I do believe because for them the over inventory correction didn't begin with the retailers. It began when that whole crypto boom happened. They were able to their process was their segment, their phase was a little bit earlier. So it seems like they're finishing this over inventory correction a little bit earlier than some of its players. So we did see a nice growth here in the gaming market. So at least for now, great thing. It seems like over inventory correction is done for Nvidia. The final one I want to take a closer look at is automotive was up 135% year over year. It's still a small portion, 294 million of total revenue. But if we take a closer look at that in the yearly basis, it was roughly $900 million. I do believe next quarter will be the first quarter where this is going to have a $1 billion annual run rate. And I honestly don't see this stopping anytime soon. I think they're going to hit 2 billion a lot faster than it took them to hit 1 billion $1 billion annual run rate because of the huge growth we are seeing in this space. And one thing that I find interesting is in the automotive market, this includes a lot of things for robotics. They do have a lot of solutions in the robotic space. So sometimes when we think of automotive, we're just thinking of smart cars, but we are seeing kind of the growth of smart robots in distribution centers and maybe soon in kind of delivery systems. So I do believe that's another force to kind of put in there. I wish they would put automotive and robotics segment there just so we can understand the growth opportunities there. Before actually, I'll jump in real quick to see if you guys have any thoughts on revenue. I'll start off with you, Nick. Any thoughts here? I want to thank the Motley Fool for sponsoring this video and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
It blew me away. It was much better than I thought it would be. I think it, like we talked about on the live stream last night, Jose, I think it as a testament to NVIDIA's farsightedness. They got really, really aggressive working down inventory much earlier than AMD and Intel did. And that is now starting to pay off. I think they said for the duration of the next fiscal year, we're going to see sequential and year-over-year growth in data center and a return to sequential growth for video games. So I don't think this is going to be by any means the highest revenue growth year for NVIDIA coming up this next fiscal year, 2024. But it is going to be a year where the return of sequential revenue growth, I think, brings the profit margins back up. And I think we're going to see some really dramatic rebounds in earnings per share and free cash flow as a result. And that's why the stock is doing so well today, in spite of the expensive, in air quotes, expensive stock price. It's because earnings are going to go from like basically zero to very robust like that.
Thank you for that, Nick. Billy, any thoughts here? I know from an outside point of view, it might actually look pretty crazy, right? I think stock price was up a nice amount. It's like, hey, what are you guys celebrating? Data center is barely up. And the gaming, sure, congratulations. You guys now are done with the over inventory correction. So I want to hear from an outside point of view here, Billy, on what you're seeing here with NVIDIA.
Yeah. I think one of the other big positives was the guidance for the next quarter. Usually that's what people react to in these earnings reports. I think they guided to like 6.5 billion, up from like 6 billion. So that's sequential revenue growth of what, like 9% or something. So annualized, that's like 36% or something. So that would be a nice bounce from the prior year. It was also encouraging that they expect data center to grow sequentially and year over year going forward. I was wondering about that, given the huge cross currents in the data center spending, because basically all of the cloud guys are slowing down. On the other hand, you have ChatGPT and artificial intelligence on the rise. So it's a big cross current. Looks like NVIDIA is going to continue to benefit. I also really like Jensen Huang pointed out that they're not just chips; they're building like a whole like AI ecosystem, like a AI as a service almost, with the chips, network connections, and software. So that was interesting. It was also encouraging that they said gaming is stable. What did they say? It was like stabilizing or is starting to recover a bit. So even if it's not going to go back all the way to what it was during the pandemic, it's good that that's not getting worse. I would say it could also mean that crypto is starting to come back a little bit because all the crypto miners use their GPUs to mine their gaming chips to mine crypto. And then one final thought, it just, God, the auto chip industry is just absolutely on fire underneath all this slowdown. Auto chips just continue to just crush it. Up 135% year over year. It's on a $1.2 billion run rate now. And it's a small percentage of their revenue, but if you got 5% of your revenue that's growing, that's doubling every year, eventually that's going to become more significant. So again, it kind of dovetails back with the memory. It's like data center, AI, and auto. Those are the two parts of the chip industry that are growing and that should have secular growth through this cycle, even as PCs, gaming, smartphones are sort of in the tank. So if you're going to look at the chip industry, you probably want a company that's at least exposed to data center and auto, at least for part of their revenue. I have this conundrum with my investments now because I'm like, well, do I want to invest in, an auto and industrial chip player who's like pure play, or do you want to play like the rebound in more generalized semiconductors? Because that's like so bad right now. That's going to rebound eventually. You just don't know when. So that's what I'm going through. It's like, do I play for a big rebound in the parts that are terrible now, or do I concentrate in the segments that are, strong and should probably be strong for through this cycle? And there's no right answer because I don't know the future, but it's an interesting kind of given intellectual battle I'm having in my head right now. And then of course you get, these big, really high quality companies that are exposed to everything, like Nvidia is, like Applied Materials is. You get a little bit of everything. So those are good ways to sort of hedge your bets, but also, if a company is really good, it's probably going to be in multiple segments of the chip industry. Anyway, I'm rambling, but good on Nvidia for being less bad than feared, and for being pretty well positioned in the AI trend. And I'll throw it back to you guys.
Thank you for that, Billy. Thank you for that, Nick. I'm just going to do one more slide and close out this episode. Just a closer look at their margins and inventory. I do want to show that non-GAAP gross margins took a big hit in quarter two. We learned from Nick while we were doing the live stream, that was down to 45.9% in quarter two of this year. In quarter three, it also took a huge hit of 56.1%. But it does seem like things are stabilizing now. Quarter four, they reported non-GAAP gross margins of 66%, and the outlook for the upcoming quarter is expected to be roughly around that point as well, which is what they were seeing last year. So it seems like non-GAAP gross margins are back intact. Reasons maybe being, like I mentioned, over inventory correction seems to be done for now. They maybe don't need to have too many incentives on selling this inventory that they have. Data center solutions continue to be a bigger portion of total revenues, and those tend to have higher margins. And finally, we did hear that this company is increasing their software solutions, which also tend to have higher gross margins. So I do believe if things start to get better, gaming continues to grow and everything else, in theory, I do believe there is at least a few expansion points that this company can see in non-GAAP gross margins as kind of the quarters and year progresses. The other final thing I wanted to mention is inventory growth. We did see inventory this quarter be about $5.2 billion versus 4.4 a quarter ago and versus 2.8 billion a year ago. So we can see this company is definitely ramping up. We know they have sales on their GPUs. They also have new products for the automotive. They have new products with the Grace CPU expected to come out. So I'm pretty sure they're building that inventory for that purpose. Finally, if you are an NVIDIA investor and you listen to the investor call, you know that there is an important event, GTC, which happens on a yearly basis. Conference is expected to happen on March 20th, I believe it is, March 20th to 23rd. Some great keynotes. They actually have the CEOs of, or some talks from founders of OpenAI and DeepMind as well. So I do believe the keynotes tend to be free, and I think you can register for free. So definitely check it out. And any final thoughts before I close out the episode from either Nick or Billy? I'll start off. Nick, any final thoughts?
No. I guess maybe just one final thing. It's too easy to say it now. It was harder last year when we were talking about it, Jose. Nvidia will be the next $1 trillion valued company. It's too easy to say that now, but I don't think it'll happen this year, but maybe next year. It's going to be the next one to join the $1 trillion club.
Yeah. Thank you for that, Nick. All right, guys. Billy, Nick, thank you for joining me as well. Thank you for joining me on this episode 16. To all the viewers, thank you so much. Make sure to find Nick and Billy. All the links are down below where you can find them and get some more information from them. So take care, have a good day, and see you all next time.